Hello, everybody. Welcome to Intermediate Accounting 17th edition video solution walkthroughs. This is for Kiesel, Weingen, and Warfield, exercise 1612. So this is from the 17th edition textbook. Authors are Don Kiesel, Jerry Weingen, and Terry Warfield. The question used in the presentation is copyright 2019 by John Wiley and Sons. All rights are reserved. This is for educational purposes only. The video may not be distributed or redistributed without the express permission of Wiley. This solution presentation is copyright 2019 through 2022 by Bennett Tchaikovsky. All rights are reserved. The opinions contained within this presentation are those of Bennett Tchaikovsky, not the authors of the textbook or of Wiley. Okay, let's have some accounting fun. So we've got over here exercise 1612, issuance, exercise, and termination of stock options. On January 1st, 2019, Nichols granted 10,000 options to key executives. Each option allows the executive to purchase one share of Nichols' $5 par value common stock at $20 per share. The options are exercisable within a 2-year period beginning January 1st if the grantee is still employed by the company at the time of the exercise. On the grant date, Nichols stock was trading at $25 per share, and the fair value pricing model determines total compensation to be $400,000. Okay, let me also just point something out here. This, if you're giving an option that's below market, okay, this is a big problem. Okay, this is like immediate compensation. In fact, I'm probably going to go through and write the author of the textbook about this because this is a below market stock option grant, and this is a huge no-no. You want to, when you're a publicly traded company, you want to basically be doing your grants at the market price. So this is accounting after dark. I don't want to see any of you get busted. That's the last thing you want to do is get busted for issuing below market stock options, because they're going to tear you a new one and you're going to take the blame for it. So this is something that I'm just calling this out right now. I will do this problem, but under protest. But I'm going to say to you right now, if you give a below market stock option and you're working at a publicly traded company, you're going to, it's just the SEC loves this. Right? They get to play Monday morning quarterback. Stock issuances are the easiest ones to come after. So again, I would just put this out there. You never, ever want to do this, but we'll go ahead and solve the question anyways. So for this particular question on January 1st, 2019, the date of grant, really not concerned with it. What we're more concerned with, that the fair value option pricing model determines the total comp to be $400,000. This is going to be over a 2-year period. So what we're going to do here is on 12/31/19, we're going to be recording stock compensation expense for $200,000. And we're going to be crediting additional paid-in capital stock options. And we're going to do the same thing on 12/31/20. So this $400,000 is being earned over a 2-year period. And so this is the first part of what we're going to be going through and recording. So the second part of this is on May 1st, 2021, is that 8,000 options were exercised. So 80% of the options were exercised when the market price was 30 per share. We don't care about the options, like what the market price is, but right over here, what we're going to do is the amount of cash that we're going to be receiving is going to be 8,000 times 20, because that was my stock price. Okay, and then over here, additional paid-in capital stock options. Okay, so my additional paid-in capital stock options right now, that has a balance of 400,000. Okay, so right over here, so the amount I'm going to be hitting to additional paid-in capital stock options This is going to be 400,000. I'm exercising 8,000 of the 10,000 stock options, right? So, excuse me. We gave out 10,000 options and we're exercising 8,000. So the amount that I'm going to be doing to additional or putting into additional paid-in capital stock options is going to be 400,000 times 80%. And then over here, I'm going to have common stock at par. The common stock par for this particular stock, again, I would never use a $5 par value. The author of the text told me he would be changing it in the 2019 edition. They're going to have a lot of rewriting to do because this should really be 0.001 or 0.01. So this is going to be 5 times 8,000 or 40,000. The additional is going to go to additional paid-in capital common stock. Okay, so this is going to be 480, 40. So this is going to be 440,000 is the way we're going to go through and handle this particular one. Okay, so to record stock option exercise. Now, when the options expire, right? So we're sitting here with this additional paid-in capital stock options. This right now is sitting in a balance of 80,000. Okay, so when the options expire, and if you are out of the service period, meaning that you didn't, so in one of the earlier questions, we had employees resigning. When we had employees resigning, and if it was in the service period, you would basically back out the amount of expense you've previously recognized, which is now starting to make a little bit more sense. But over here, when you're going through, and now with these options expiring on 12/31/23, we need to get rid of the remaining 80,000 bucks for the stock options. So here, we're going to debit additional paid-in capital stock options, and this will be 80,000. And what your book is showing is going to be additional paid-in capital expired stock options. Okay. Now, this kind of goes through my big issue with stock options. Okay, so to record stock option expiration, which is mainly we are artificially deflating our income statement for stock options. And again, I want to applaud Meta companies. That's not Ron Artest or Meta World Peace going and starting up his own company, but again, going over here to Meta Platforms. And if I look at their most recent quarterly report, I've shown this before for Facebook, what you're going to find is that they show on their income statement the amount of share-based compensation is included in their numbers. This is how much the financial information is starting to get distorted because of the stock options. So again, I don't necessarily, this is GAAP, right? I don't necessarily agree with it, but that's my own personal opinion, right? It's not, if I was filing this for a publicly traded company, this is how I would go through and do it because I don't want to go to federal prison. Never, ever, ever want to go to federal prison. And by the way, this question is an absolute disaster. You do never, ever, ever want to give a stock option below market value. Never, ever, ever do it. So again, if you got one thing from this question, aside from me getting really pissed off, is that this is a big problem. And I'm going to write the textbook author, this needs to change. But I can tell you right now, if you do this and you end up in the federal slammer, you won't have any sympathy for me. But anyways, I know that's not going to happen to you because now you've learned your lesson. So anyways, thank you, Wiley, for putting me in jail. No, thank you, Wiley. Again, I really do not like accounting textbooks. Not a big fan. However, I'm a pretty huge fan of this book. Again, I learned on the 6th edition. We're now on the 17th. That's how old I am. But again, I want to thank Wiley for allowing me to use their textbook. And please don't forget to like and subscribe. If you would like to see other solutions, please feel free to ask for them in the comments. Have a great day.